Pricing profitably for your product's value. Pricing is one of the most powerful ways to improve or destroy profits. A Deloitte pricing effectiveness benchmark study found that companies that actively pursue pricing as an important part of their strategy typically outperform industry peers on several financial metrics. Companies that are pricing leaders are 26% better at managing true profitability. A McKinsey and Company analysis of S&P 1500 companies calculated that a price rise of 1% if volumes remain stable would generate an 8% increase in operating profits, an impact nearly 50% greater than that of a 1% fall in variable costs such as materials and direct labors, and more than 3 times greater than the impact of a 1% increase in volume. A McKinsey on Finance article noted that committed leadership on pricing strategy improves a company's operating profit margin by between 2% and 7%, often doubling historic profit margins. Despite pricing's crucial importance for improved profitability, companies do a poor job of it. A Bain & Company survey noted that most companies call pricing a high priority in our global survey, but 85% say that they have significant room for improvement in pricing. A Harvard Business Review article reviewed pricing studies and concluded this and many other studies indicate that pricing managers routinely set prices too low, sapping their company's profits. With so much profitability at stake, surely companies would focus on improving pricing. Unfortunately, the Bain survey found that poor pricing practices are insidious. They damage a company's economics but can go unnoticed for years. This course is one of 3 pricing courses to help you improve the pricing practices at your company or to help your clients make better pricing decisions. Price is a function of the value provided to customers. This course focuses on customer perceptions of value and their willingness to pay for that value. I'll start by explaining the concepts and calculation of value-based pricing. Understanding what customers value and whether they are willing to pay for that value should drive your company's strategies and costs. Who determines value? The customer makes the ultimate decision when they decide what price they are willing to pay for a product and which product to buy, if any. Behavioral finance offers insights into how customers determine value. I'll explain how. I'll walk through a price differentiation and segmentation concepts and examples. Estimating the price response function helps a company better project sales volumes at a new price, which is important for deciding whether to change prices. I'll finish the course by touching on pricing ethics. Customers must perceive pricing to be fair for them to be willing to buy a product from a company. I also offer 2 other pricing courses. They are Pricing Profitability Analysis and Processes. I explain how to analyze pricing decisions to improve profitability. Cost plus pricing is a popular pricing methodology, but I explain its weaknesses. I also cover how many parts of a company can work together to improve pricing. Pricing profitably in the face of competition. The focus of this course is how other companies can impact prices. I show how to analyze the profitability at stake by responding to customer pricing. You'll learn common pricing strategies relative to market pricing. Finally, I'll show how to identify and reduce poor discounting practices. Each course looks at pricing from one of 3 perspectives. Pricing for profitability analysis and processes. Pricing profitably for your product's value, customer perceptions, and action. And then pricing profitability in the face of competition focuses on competitive pressures. Each course starts with one of 3 pricing methodologies. Pricing for profitability explains cost plus pricing and its weaknesses. Pricing profitably for your product's value shows the benefit of value-based pricing. And pricing profitably in the face of competition lists the pros and cons of competition-based pricing. A robust pricing program considers all these perspectives and methodologies. These courses focus on financial management and profitability analysis of pricing. Pricing is a major role of a company's CFO. The McKinsey on Finance article mentioned earlier noted, in best-in-class pricing organizations, the CFO commits at least 20% of his or her time to the pricing effort. This compares with an average of only 10% found in an annual executive survey. I'm Rob Stevens, founder of CFO Perspective. During my career, I've been the CFO, SVP of finance, or director of operations of companies with just a few employees to companies with $3 billion in assets and hundreds of employees. I've chaired the pricing committee or worked with others to set pricing at these companies. I make courses for company employees as well as for business advisors like CPAs, coaches, and consultants. When I say you, I'm referring to business owners or staff. If you are a business advisor, you can translate you to mean your clients or the business you work for. The titles for the financial staff that analyze pricing are different for each company. I refer to the accounting, finance, or FP&A, which is the finance planning and analysis function, or department that usually do this as finance in this course for simplicity. I also use the term product to mean both products and services for simplicity. No one wants me constantly repeating the phrase products and services. I will give examples of the course concepts using relatively small dollar amounts. I do this to make it easier to read, say, and fit on a page or screen. Please feel free to add as many zeros as you need in your head to scale the examples to an amount relevant to your company or situation. With those guidelines in place, let's dive into pricing for profitability. Value based pricing. Value based pricing sets prices based on how much customers value a product. Many pricing experts believe this is superior to basing prices on a company's internal costs. Let's explore how value based pricing can improve a company's profitability. Let's start with some foundational concepts. Your business provides products that have value to your customers. Business customers use your products and the products they sell to their customers. The product sold to their customers is a combination of the value of your product and the additional value they provide. A manufacturing business customer uses your product as a component part in their physical product. Your retailer business customer sells your product along with other products and services to end customers. The business customer may be the end customer, in which case your product may reduce your business customer's costs or provide services for their employees. You may provide a financial benefit like cost savings for your consumer customers. Often, consumers value products for the subjective benefits they provide, for example, peace of mind, status, etc. Pricing is a sharing of value or splitting of value between buyers and sellers. It's an exchange of price and value, but both buyer and seller benefit. If both don't, then no sale would take place, assuming there is no coercion. A graphic I like to use to summarize this is my value creation Venn diagram. Business owners, via their company, receive value when they provide value to employees and customers. True business success is an exchange and sharing of value. In value based pricing, a price is determined by how much the customer is willing to pay for the product or service, given its perceived worth or benefits. Those who set prices take into account the customer's perspective and the unique value proposition of the offering. Let's look at this more linearly. A successful business model is one in which your costs are lower than how your customers value your product. It looks like this. Financial analysts and management accountants are experts in determining the cost of a product. The trickier questions are, how much do customers value, in monetary value, the product? And where should pricing be set between cost and value? The image of cost, price, and value also shows why value based pricing is considered superior to cost based pricing. Pure cost based pricing sets the price at a fixed margin from the cost. Value is not considered when setting the price. Thus, the price could be above the customer's value for the product, which means no sales. Even if the price does happen to lie between cost and value, it may be set at the wrong point between cost and value. Prices and profits could be higher. Even proponents of value based pricing admit that determining value can be difficult, especially for consumer goods where value is very subjective. I'll explain later ways to estimate value and why finance staff who are experts in calculating costs can also help assess value. Value to a customer can be broken into use value and economic value. Use value is the practical value or usefulness of a product in fulfilling the customer's specific needs, desires, or goals. Some examples include cost savings, improved satisfaction, more revenue or income, less hassle, higher status or prestige, time savings, reduced risk, increased performance, and increased quality. Some of these are easier to quantify than others. Some are very objective. How do we translate these to a number for pricing? Economic value calculations can help. Economic value to the customer, EVC, is the perceived value or utility that a customer derives from using a product or service, considering both the benefits and the price they pay. It can be summarized in the simple formula EVC equals benefits minus costs. Let's look a little more closely at the two components of that formula. Benefits are what the customer gains by using the product. I listed examples of use value in the previous section. The benefits can come from obtaining a gain or avoiding a loss. Cost is the price paid by the customer and all ancillary costs. Ancillary costs can include implementation costs, training costs, and conversion costs. Everything I've said so far is true for a customer who wants to optimize their EVC. Absent any competing products to yours, it may be how they calculate the value of your product. However, there are almost always products competing with your product. In this case, customers determine the economic value of your product relative to a reference product, in other words, the product competing with your product. EVC is then determined as EVC equals the reference price plus the differentiation value of your product. This image summarizes all the components of value and pricing. In this example, your competitor's product is priced at $20. This is what's labeled the next best alternative or reference value in the lower corner. You have estimated that your product has benefits that your competitor's product doesn't, which total $50. This is the positive differentiation value. On the other hand, you lack $15 of value that your competitor provides. This is the negative differentiation value. The difference between your $50 positive differentiation value and $15 negative differentiation value equals $35 of net differentiation value compared to your competitor's product. The total economic value to the customer of your product is the $20 of reference value plus $35 of net differentiation value, which totals $55. What prices should you consider? The image says that your price should be between your cost of $15 and the value to the customer of $55. There may be times when you price below your cost for a customer or product. However, the sum of all your revenues from all your customers and products must be above your total costs for you to make a profit. You may be so impressed with the value based pricing image that I just showed that you've already ordered t shirts with the image on them for everyone to wear at your next pricing meeting.